Okay, hi everybody. It's Kevin from NorthStarBadCharts.com. I was going to do this recording for our website members, but I think at this point in time, it's probably important that I put this out there for everybody to take a look at, just so that we can clearly state what our view and position is with regards to gold and the markets and what's going on at the moment. Just before I move on to that, I would like to say that the charts, as I've been saying for the last couple of years, and particularly the last year, look very, very concerning from many points of view and many angles, many respects. And I do believe that what we're going through at the moment is a generational shift in both the investment landscape and also the political landscape and the geopolitical landscape. So we've heard many commentators, many who are far more qualified and experienced than I am in geopolitics, talking about that on our show, of course. So if you want to take a look at that, look at the other videos on our YouTube site here, and you'll see a lot of the discussion around that. But we are entering some very, very dangerous months ahead for the global community. So yeah, I'm not going to dwell on that too much, but what I want to look at here is, as I said, gold and gold and SPX and what it's telling us and what we can expect over the next few months, or what we can deduce is likely to happen over the next few months. So I'm going to take a look at the charts now. I'll stop sharing my ugly face. I'll stop the video on my face and I'll start sharing my computer screen. So what we're looking at here is the spot price of gold going back to the 1960s, okay, and there has been a very clear cyclical behavior to the gold price. What I mean by that is that, and this is the quarterly chart, so each one of these candles represents 3 months, okay, stretching from the 1960s to today. And if you look at the price action, you can see that every 27 to 34 quarters, okay, 27 bars, that's 27 quarters, 34 is 34 quarters. So every sort of just under 7 years to around about 8.5 years, gold hits a major cyclical low, and I've marked those with the red vertical lines for you. They're pretty clear, pretty reliable. This here is the 2008 crash, which you can hardly see actually on the chart, but it came down here to a low of $681 when it had been up at around about $1,000. So it was a sizable drop there in 2008. That was the 8-year cycle low. And then, of course, we had another one in late 2015, early 2016. Well, in fact, October 2015 was the quarter that contained the low there. Well, just winding it back a little bit, you'll notice that I put these support lines on, okay? And the support lines indicate what you might view as the 30-year cycle, 1970 to 2000 and 2000 to 2030. If you subscribe to the idea that gold has a 30-year cycle, and within that a 15-year cycle and a 7.5-year cycle, which is fine. I can see the 7.5 to 8-year cycles. I've marked them here with the vertical lines, but the 30-year cycle. Now the question is, when did the 30-year cycle start? Did it start in 1970 when gold became free floating and the abandonment of the Bretton Woods Agreement? And is that where we start the 30-year cycle? You can see how gold broke down below this rising trend line, and we had from 1984 to 2000, we had 16 years effectively of gold going nowhere, and in fact the trend generally being down. So a decade and a half of declining gold prices. Now you can see, if you do the same thing again starting in 2000, at first glance it doesn't look good, does it? Because we've broken down below that rising trend line and we're going sideways. But I'd like to draw your attention to some differences here. One major difference, of course, is that in 1980 we hit, in fact it was late 1979, I think it was, early 1980, when we hit $873. Now, after the base formed and we had the rebound, it only made something just above $500. So it was a good sort of 40% or so off the all-time high. That's very different to what's happened here, because in the 2011 peak, we made $1,920, and then more recently we've made $2,075. So we have a higher high here. So that is a significant difference to the previous behavior. Another thing I'd say is that this support line is very important. So at around about 1550, and I really wouldn't want to see that support line broken to the downside, because that would open up the possibility that the 8-year cycle low or 7.5-year cycle low is going to occur sort of 12 or 18 months from now, and that we just keep descending down into that low point, which we don't want to see. The alternative scenario is that we're putting in the 8-year cycle low now and we just march much, much higher, or we are putting in a low of some sort now, move higher, and then come down into an 8-year cycle low in a year or year and a half's time, because we've still got, well, we've got 27 quarters so far, and we can have a maximum, historically speaking, of 34 quarters. So we can now have another 7 quarters of, so that's nearly 2 years before hitting that cyclical low. So there is time for us to actually turn around here, move up to a large extent, and then come down into a major cyclical low. So there's kind of 3 options there, three paths forward. But what what I want to address in this podcast is the idea that gold is going to continue down from this point, and that we have, you know, much lower lows ahead, as opposed to some kind of move up, either a sustained very long move up or a move up into the perhaps the mid 2000s before coming down into that 8-year cycle low. So we've got 2 scenarios where we could go up, and we've got a scenario where we break support and we continue down and get possibly much, much lower. Okay, so to address that, I've been taking a look at the gold to SPX ratio, and that's what I've just expanded up on the screen here for you now. So for gold to progress well, we need capital flows on our side, be it from the S&P or from the bond market or from other sectors of the investment landscape. Now, looking at gold versus the S&P, if we break out, then it strongly suggests that capital is flowing away from the S&P towards gold. Now, of course, both elements could be moving down in actual price, but gold moving down much less than SPX. But it does indicate gold outperforming SPX if this chart is moving up. And you can see that happened in 1969, 1970, that kind of time period, and also in the early 2000s. We hit the actual low here in 2000, but broke out a couple of years later. And of course, we know what happened after that. Gold went on a huge bull run where it increased from around about $300 to $2,000. It went up by about 8 times. And interestingly, the appreciation in gold price from 1976 to 1980 was around about an 8 times increase, an 8-fold increase. If you ignore this move from 1970 to 1974, where gold was a bit like a beach ball bouncing out of the water, and it's finding its kind of footing, finding its value, if you like, measured in fiat currency, it did that, settled down, and then we had an 8-fold move. And interestingly, we had an 8-fold move from 2000, around about 2000, 2001, all the way up to the top in 2011 and 12. So what's happening now is that we have another clear resistance line, and we're just touching that at the moment. We've just been rejected from it, and price has just been pushed back. But what I'm saying to you is that until gold versus SPX breaks out, we haven't actually started the real powerful portion of the gold bull market. And if you pause and think for a moment, gold moved from 1,050 to 2,075, so it doubled in value, but we weren't even in a bull market versus general equities. It was just you could term it a sort of a bear market rally versus the SPX. It was this, if I just move the chart back down again, it was this period here from 2015 to 2020. And looking back at this chart here, 2015 to 2020 was really just a sideways move for the ratio. Of course, SPX was going up, and so gold went up as well. over that 5-year period by a similar proportion. Okay, so that's all very interesting. So let's bring some more evidence into it, and bearing in mind that for our members of the website, we look at many pieces of evidence, and this is just 2 of them here that I've pulled out for you. And this is the TNX chart. It's the US 10-year Treasury yield. And what I'm wanting to show you here, and if I just minimize that one, okay, what I'm wanting to show you here is that in the period through the 1960s through until 1985, the 10-year yield was rising, and it was supported by a rising support line. Okay, that situation changed when it broke down, and for the next 40 years, the 10-year yield was capped by a resistance line. Okay, so here price kept going up because every time it tried to break through the support line, it bounced back up. Now here, it was the opposite situation. Every time it tried to break out, it got pushed back down for 40 years until we broke out. Okay, now if you look closely and look back to 2000 and early 2020, for the last 2.5 years, we've been rising on a support line just like the 1960s. See the TNX there in the 1960s was rising and been pushed up on a rising support line. I've just mucked up the line there by doing that. I just need to just adjust the scale. Just bear with me a moment. Okay, there we go. The line's moving around. So yeah, in the 1960s and 70s there, we had a rising support line that we broke down, and now we have the same again. We've got a rising support line having broken out above the resistance line. So this is telling me that the regime that we're in, the paradigm that we're in, is more like this, more like the 1960s and 70s, where gold was, well, certainly once it came off the US came off the gold standard, gold was rising and rising and rising and rising and rising. So that is one piece of evidence that tells you that we're, as far as this chart is concerned, we're now back into that regime. And when you put that alongside the chart above, if the chart above breaks to the upside, that's yet more evidence. And if the gold chart itself holds support and turns around, then that's yet more evidence. So you see how we start to build up an evidence picture here. And as I say, I'm just using 2 pieces of evidence here, but you also have things like, for example, the 10-year yield divided by the 2-year yield. You have the gold to silver ratio. I have SPX versus inflation, gold versus inflation. All of these charts come together to build a picture of what's going on and whether, in fact, the position that we're in now is comparable to the position that we were in during this time period here, where gold just went nowhere for over a decade. So something for you to think about before you write precious metals off completely. And certainly we will be alerting people at our website as soon as we get that breakout, or if and when we get that breakout on the gold versus SPX ratio, because that will be very telling indeed. So that's it. As I say, just something for you to chew on and think about over the weekend, and I hope you all have a fantastic weekend. Bye bye for now.